up about 1/3% for the sensex and the nifty.
At the day's low, we are sitting with cuts of around 28 points at a 100-point downtick from the highs. Mid-cap index, it is in fine fettle. That one is up around 170 points. Not much has happened, a very narrow trading range. The cash market volumes as well below 50,000 crores.
Strong run-up is what we saw over the last few trading sessions, and some profit-taking out there is what we saw on the frontline index, but it was a better performance from the mid-cap index, so to say. The index was up by almost 1/3%.
Hello and welcome to CNBC TV18. You're watching Markets Today, the show where we track 6 hours of the day's trading action in just 5 headlines. I'm Sonia Shenoy, and here are all the top headlines for the day. The Lal Street snaps a 7-day winning streak. The Sensex and the Nifty end in the red after profit booking. The rupee remains on a tight leash below the 83 level against the dollar. And Reliance reports a weaker than expected quarter for the O2C business, hurt by the windfall tax, even as telecom and retail report strong performances. ICICI Bank and Kotak Mahindra Bank deliver strong growth with higher margins, but mid-rung lenders RBL Bank and IDFC First see slippages rise. JSW Steel gains after the company tells CNBC TV18 the margins will improve in the second half of the year, and the company has spared some debt despite an adverse forex impact. And IGL gained close to 6% despite reporting a miss in the second quarter after the management said that the gas price rise was temporary, while Laurus Labs fell close to 6% on a weak quarter two. The company also cut its guidance. All right, here's the lineup of what we have in store for you in the next half hour. It's a packed show today. In Market Opinion, we have Ajay Srivastava, the CEO of Dimensions Corporate Finance Services, and Richard Harris, the Chief Executive at Port Shelter Investment Management. In Big Corporate Voices, we have Seshagiri Rao, the Joint MD and Group CFO of JSW Steel, and V. Vaidyanathan, the MD and CEO of IDFC First Bank. Also, Prashant Kumar, the MD and CEO of Yes Bank, will be with us. Well, straight to all the action from the Lal Street. The Sensex and the Nifty snapped their 7-day gaining streak due to profit booking. Financials and FMCG stocks dragged the markets today. The Sensex slumped nearly 300 points and the Nifty ended below the 17,700 mark. It was largely a day of profit taking, you'd have to say. After a very strong Samvat session yesterday, the market chose to give up some of its gains, the Nifty ending with a cut of about 74 odd points. The mid-caps outperformed in trade. FMCG stocks were under pressure today, so that was the pocket that really got hit hard, whether it's HUL post its numbers, which were below street estimates. There was Nestle, Britannia, Asian Paints that all ended in the red today, down about 1 to 2 odd percent. Then you had other heavyweights that dragged. Reliance Industries was under pressure post its numbers, as well as names like HDFC, Bajaj Finance and Kotak Mahindra Bank were down about 2–2.5%. On the gaining side, technology stocks didn't do too badly. In fact, you had Tech Mahindra, Infosys and TCS that ended in the green. And auto stocks did well. So Maruti, Eicher Motors, Tata Motors and M&M were all in fine spirit today. In fact, tech stocks have been rallying through the course of the month of October. So totally, if you put together, names like HCL Tech, Infosys and Tech Mahindra are now up about 8 to 10% in October so far. It's been a pretty steady rally for the Nifty IT index as well. And a lot of banks hitting fresh 52-week highs today. SBI, ICICI Bank, Bank of Baroda, Canara Bank and Federal Bank all ending with fresh 52-week highs today. Finally, on the downside, you had stocks like Nykaa that were under pressure. In fact, Nykaa was down about 2.5%. Remember, the stock is now below its issue price, and there is the pre-IPO shareholders lock-in, which expires on the 10th of November. Post that, there is some profit taking as well that could be seen on Nykaa. Well, in Market Opinion, Ajay Srivastava, the CEO of Dimensions Corporate Finance Services, suggested that fixed income can fetch you better returns and that it is the right time to invest in the fixed income market. He also added that there's a paradigm shift in the long-term investment concept. Take a look.
This is the best time to allocate, and you have not done it, a lot of investors have not done it for a while, to go into fixed income. If fixed income will give a better return, it has given better return. If you look at 5–7 years, it's given very good returns when you were in the last cycle of rate increases and you rode the whole capital gain right up to the point where post-COVID happened. I think the same cycle is happening. You will get better returns than equity markets broadly. And we've seen oversubscription of, just now we saw the bond subscribed at 7.9% interest for 25 years. Now, these kind of opportunities come once in a while. So there is a clear case that one needs to pedal down a little bit your equity inclination, no matter how exciting it looks, and move a lot of your money into the fixed income. And that's where they're given money. There's a good number this year, but only fact is depending on from where you look at the whole market, it's like an economy is like a glass half full. Some people feel optimistic that, listen, the worst is behind us. Some people can feel pessimistic that the interest rate and inflation will come through and the demand is slowing down. So it just depends upon where you look, from which side of the market you look at it, and you decide whether you want to be optimistic or pessimistic. But one thing we know for sure, and I think that's what the market has taught us, is that the paradigm of this long-term investment concept is gone now. I think you need to learn to be flexible, fast, nimble, and get out of stocks once they reach a good point of valuation from a comfortable point of view.
Okay, in more market outlook, Richard Harris, the chief executive at Port Shelter Investment Management, said that India has been quite resilient compared to other emerging markets. He also added that after global investors retreat home, they will look at emerging markets like India. Take a look.
I think what we've seen is that India has been quite resistant compared to many other markets, especially emerging markets. If you look at how difficult China has been, there's a theme going through, though, that we've seen that where, if you like, policymakers have tried to buck the market, they've been punished. It's happened in Japan, where policymakers have not wanted to increase interest rates, so the yen has collapsed. I think global investors will tend to retreat back home first, and then maybe look at other markets to move in, in terms of allocations. People are, I think, generally on the more conservative tack, and when they do that, they tend to return home rather than reallocate to other emerging markets. India is very good, for instance, at generic drugs. It's very good at certain elements of the economy, certain industries. And as a multi-market, a global investor, you tend to want to focus on where the country is good at. France is good at luxury goods. China actually is quite good at electric vehicles, so I wouldn't be totally out of China whatsoever. But I think what investors need to do in India, if you're looking at the foreigners, is to say, where is India special? Where's the economy special? And really focus on those sectors.
Okay, that's the word coming in from Richard Harris. But to the second headline now, Reliance Industries fell 1.5% after the weaker than expected second quarter numbers. It's the O2C business which was hurt by windfall taxes, even as telecom and retail reported strong numbers. Now, if you look at the numbers overall, as I said, it's the telecom as well as the retail business that had a very strong showing this time around. But the O2C business has been under pressure, and that really dragged the stock down as well. It was record quarterly revenues for the retail business, and consumer-facing businesses are now contributing almost 50% to the EBITDA for Reliance Industries. There were two other important pieces of information. One is that the company has announced a restructuring of the EPC business and a demerger. They've also announced a listing of the financial services business, which is a fairly small portion. It's just 6% of their total assets currently, but they look to eventually list that and enter into the financial services space in a big way. JP Morgan has an overweight with a target price of 3,065 on Reliance. HSBC has a hold call with a target price of 2,500, while Jefferies retained a buy with a target price of 3,090. But the weakness in the oil to chemicals business is something that dragged the stock lower today. But here's the third headline. ICICI and Kotak Mahindra Bank delivered strong growth in Q2, but mid-sized private banks like RBL and IDFC First reported a rise in slippages. PSU banks do not need any additional capital, says the government. Sources who expect profits to touch 1 lakh crore rupees this financial year. Ekta Batra has put together the key numbers for us. Ekta, over to you.
Well, yes, I'll really start with the star of the banking space, which was ICICI Bank. Loan growth was at a 27-quarter high. ICICI Bank's global net interest margins came in at 4.31%, which was again at an all-time high. And ICICI Bank's gross NPA improved and was the lowest in 31 quarters. Kotak net interest margins came above 5%, so 5.17% is where it came in at, so it was an improvement on a Q-on-Q basis. Loan growth was 25% on a year-on-year basis, and slippages were below 1,000 odd crores. The street, however, seemed to be a little worried about the net interest margin sustainability going forward, and according to a lot of the brokerages, the valuations probably capture a lot of the optimism that we're seeing in the earnings as well. RBL Bank operating profit was down 26% year-on-year, which was the fifth quarter for year-on-year decline. Slippages were higher as well for RBL Bank at over 800 odd crores. IDFC First Bank, slippages remained elevated. Yes Bank, the profit was down over 30 odd % year-on-year. That was because provisions had spiked up over 50% this quarter. Lastly, South Indian Bank, one of the smaller ones, but did see a sharp reaction on the upside. ICICI Securities upgraded the stock to buy from hold with a target price of 13 rupees. They've said that the improving trajectory in the operating performance sustained for the third consecutive quarter for South Indian Bank.
Going forward, this kind of aging kind of thing we are not seeing, okay, and the credit cost would remain under guidance. If you see our slippage continuously coming down, our net NPA number has come down to 3.6%. Our gross NPA number has come down to now below 13. We started this journey with a very, very large NPA pool. And if you see, there has been a continuous improvement, both in terms of NPA number coming down, also in terms of slippages continuously coming down. So I think there has been a good traction. And once the transaction on the ARC would happen, our gross NPA number would come down to 2% and net NPA would be around 1%. Loan growth of around 15% is something which we would be able to achieve without any issue. The equity contribution from the bank, even for 19.99%, would be somewhere between 300 to 350 crores. Whereas the 15% which we would be getting would be something around more than 1,000 crores.
In the nature of a business, something flows, something writes back, or flow back. That's part of life. So I want to just tell you that our provisioning coverage ratio on the retail book is now 77%. So you should look forward to actually lesser slippages. You should look forward to lesser provisions from the bank going forward. Maybe in that corridor of 5.8 to 6 through the rest of this year, you can expect NIM to happen. You can expect deposits to come. You can expect loan book to grow. Our understanding that our return on equity, which is right now touched 10% pretty quickly, as you notice, from 0 to 10 in 3 years, our return on equity adjusted for all costs will start crossing 15 by end of, as per the guided plan, by the exit quarter of FY25 or so. So we feel that this bank will not even stop at 15 ROE. The core economics are such that it will take us towards more like the 16, 17, 18-ish ROE. But we will get there.
Okay, well, now let's look at the profit figures of public sector banks. Government officials have told CNBC-TV18 that PSU banks are expected to register profits worth 1 lakh crore rupees in FY23 as compared to 60,000 crore rupees in FY20. This will be a 25% growth in PSB's profits year over year. Sapna is here with more details on all of that. Sapna, over to you.
Well, these are indications that have come in now and somewhere around now. So 25% over 66,000 crores of PAT FY22, that will give you a figure of around 82,000 crores. But there is expectation, there is hope within government circles that maybe 1 lakh crore could be feasible in the current financial year itself. Maybe if not 1 lakh crore, at least around close to that number. So it could be around 95,000 crores anywhere in that region. That's what we're given to understand as of now. The banks are also well capitalized as of now. The CRAR is pretty healthy. So obviously, even if you look at the trend in the last 2 financial years, there hasn't been any recap, so to speak, any big recap that has been done by the government. So maybe they're completely out of the woods finally. But last but not the least, the point here is also this, that interest rates, high interest rates could also have an impact. So maybe that will come and kick in with a lagged effect. You cannot say whether this will be in the last quarter of the current financial year or this could actually come in somewhere around the new financial year, first quarter maybe. But there could be a lagged impact of high interest rates on bank balance sheets. So that's the counter that we have to watch out for. But as of now, it's a very positive commentary coming in from government circles.
Okay, thanks a lot, Sapna, for that. Well, let's head into a break, but we leave you with some market opinion. We'll return with more news from Dalal Street after this short break. Stay tuned.
We are hoping for a 10-year bull run in equities in India. Why would I buy gold, which pays me no dividend? It won't even tickle me back. So I'm very clear that I want to remain invested almost fully in equity. I don't even like FDs at this point because inflation may eat up into your returns out there.
When we separately say that India is in a better situation relatively because we have less interaction with the world, we have less supply chain, we have less this, then we should seek stocks which are more related to those themes. But in any case, I think everybody does well. Everything might do well if the market is up. But we think that non-IT will do better than IT.
Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines now that we're tracking for you. The fourth headline today is JSW Steel surged over 2% despite reporting a major miss on EBITDA and margins for the second quarter. The company reported a net loss of over 900 crore rupees. However, the management expects an improvement in profitability in the second half of this fiscal. The joint MD and CEO of the company, Seshagiri Rao, also said that the benefit of lower coking coal and iron ore prices will be evident in the next quarter. Have a look.
In this quarter, we expect the steel prices to be stable and better volumes, and at the same time, costs are going to come down. So all this together, I think Q3 and Q4 of this financial year will be much better than what you have seen in Q2. The FOB price of China is $580, $590 per ton. If you take another $40 as the transportation cost and multiply by 83 rupees, which is a rupee dollar, and if you have to pay 7.5% duty and then add the port charges and other costs relating to imports, then the landed cost is almost equal or maybe slightly higher than the domestic prices today. Whatever prices as on date, if you take into account, and then see what is the benefit in cost that can come in the Q3 over Q2, then there could be $80 per ton of coal used in the consumption. That is the kind of benefit we are expecting to come in the Q3. As far as iron ore prices are concerned, the overall reduction which has happened in the Q2, that has happened in phases, something in July, something in August, something in September. So the full benefit of lower iron ore prices have not flown in the consumption in the last quarter. So that benefit also will come in the Q3.
All right, and let's move on to the fifth headline today then. IGL rallied over 6% and despite reporting a miss in its second quarter, the results were marginally lower than street estimates. However, the company reported a beat in revenues on a quarterly basis. Meanwhile, the management believes that the rise in gas prices is temporary. Sonal Bhutra joins in with the key earnings highlights. Sonal.
Spoke to the management earlier today and there was positive commentary coming in from them. But first, the numbers where it was a big miss on EBITDA. EBITDA margins came in at 14.8% versus expectation of 17.7%. EBITDA was also down 15%. EBITDA per unit came in at 7.1 rupees per SCM versus a poll of 8.8 rupees. Volumes, however, for the company at 8.1 SCMD were at a multi-quarter high. We spoke to the management and asked them their outlook for the coming quarters as well. And they said that the pressure on margins that they are seeing is temporary. They expect gas prices to go lower from these levels. And the Kirit Parikh committee, which was set up in order to revise the pricing formula for domestic gas, the outcome or the report should be out in few weeks itself. They are also looking at acquisition of a smaller city gas distribution player. It is at the discussion stage, but something should be finalized by this year end itself. And that is something which will add to the volumes for the company. That is what they say about volumes. They expect volumes to be around 10 SCMD in next 2 years. So that's a big jump from current levels. So positive commentary and expectation of a gas price cut also is something which is propelling the stock higher today. In fact, we spoke to the management. Let's listen into what they had to say.
Even if we earn slightly less, even if our earning per SCM is slightly less, we would like to grow to 10 million cubic meter per day. Presently, this quarter, we are at 8.09 million cubic meter per day. And we hope to reach 10 million cubic meter per day in 2 years from now. And that is our prime target because we feel that the gas prices are temporarily at such high. The moment the geopolitical issues are resolved and the government has taken a very significant initiative in the form of Kirit Parikh committee, we hope they will look at the problems that CGD sector is facing and they will come up with certain solutions that people are discussing about presently.
All right, that's on IGL. But Laurus Labs fell close to 6% after a weak second quarter numbers, as well as after the company went ahead and cut its guidance. Ekta is here with more details on that. Ekta, over to you.
Well, yes, Laurus Labs continued its decline into today after a sharp decline that we saw on Friday's trading session by around 8 to 9% after the company really cut its guidance that it had for FY23. Now, in terms of the numbers, they were largely stable. Revenue growth was 30%, margins at 28.5%. The growth was largely led by the synthesis division, which was up around 360% on a year-on-year basis. But the street seems to be skeptical about whether those numbers can sustain and how much of it was led by probably one COVID-19 related order. The pain point was the formulation segment, which was down 70% on a year-on-year basis, and that was largely led lower by the antiretroviral segment, which is basically the ARV segment, which did see some amount of volatility this quarter. The company has cut their guidance. So for FY23, they've cut their guidance by 10% for the $1 billion that they had guided the street previously. They are expected to achieve around 6,500 crores in terms of total revenue going forward for FY23, which would still be a double-digit growth, but the street doesn't seem to be enthused at this point in time. The management, talking to CNBC-TV18, did mention that they do expect a recovery in the ARV segment in the second half, but when we asked them about whether or not the $1 billion would translate into FY24, they seem to be quite tight-lipped in terms of providing a guidance for FY24.
All right, Ekta, thanks a lot for that. Well, moving on, we also have Yash Jain joining in now to give us an update on what's been happening with the insurance regulator IRDAI, who has issued an exposure draft proposing amendment to reinsurance regulations. They've also proposed that the order of preference favouring GIC be removed, and stakeholders have been given time till the 11th of November to give their feedback. Yash has more on that. Yash.
Well, the insurance regulator has released a draft consultation paper which essentially proposes certain amendments around the Indian reinsurance sector. As far as these amendments proposed by the regulator are concerned, they seem to be taking away the biggest advantage which GIC RE, the homegrown PSU reinsurer, has as far as the Indian reinsurance sector is concerned. The insurance regulator, through this draft paper, has proposed to remove the order of preference which essentially gave GIC RE a big advantage in the Indian reinsurance space. To understand this better, I'll first take you through what the current regulations are and then what has been proposed against it. As per the current regulations, if any insurance company wants to reinsure any particular policy, what it has to do is it has to seek quotes as far as that policy is concerned from GIC RE and also 3 FRBs or foreign reinsurance branches. Once these quotes are received, and assuming the lowest quote is from one of the foreign reinsurance branches, then that lowest quote has to be disclosed to GIC RE. GIC RE has to be given a chance to match that quote, and if GIC RE chooses to match that quote, then the business goes to GIC RE. The insurance regulator, through this draft paper, has sort of attempted at removing that particular order of preference. They put foreign reinsurance branches along with GIC RE. What that does is that insurance companies will of course have to seek a quote from foreign reinsurance branches and GIC RE, but they won't have to disclose the lowest quote to GIC RE and give them a chance to match it. They can straight away give that business to the lowest quote, even if it's come from a foreign reinsurance branch. This does two things. This essentially gives the foreign reinsurance branches a level playing field when it comes to the Indian reinsurance sector. Also, it increases the competitive edge as far as the reinsurance business itself is concerned.
All right, with that, it is curtains down on this edition of Markets Today. Thanks a lot for watching. Keep it with CNBC TV 18.